You were talking about, and that's the reason why I asked you to come in this evening, about ETNs and ETFs. From my understanding of it, and I didn't get it all, to be honest, is it ETN buying into debt and an ETF buying into assets, or what, how would you define
the simplest definition? ETF, well known, we've got lots of them in South Africa, had them for a decade, and the difference is that they physically, like the Satrix 40 tracks that top 40 index, they physically go and buy the shares and ring fence them. So you've got pure market risk only. In other words, if something were to happen to the management company or something like that, you're protected in that sense. An ETN is a note. In other words, it's a promise from the issuer to pay you that difference. So if it goes from 10 Rand to 20, they're promising to pay it. They don't need to buy that underlying asset. So you're taking, in the simplest form, what we call a little bit of counterparty risk. In other words, you haven't just got the risk of what the assets are, there is a risk that something goes wrong with that issuer, or they're unable to honor their obligation, the promise that they've made. Brings a little bit of extra risk. Now, in truth, you know, the people who are issuing them are large financial institutions, and if they were to go and start reneging on their ETNs, we'd probably have bigger issues in our financial system locally and certainly globally. But it does bring a little bit of extra risk. The reason they've brought it in, for example, there's an ETN on oil. You simply can't store oil that easily. Gold bars, easy. But stick them in a vault, lock it, keep someone at the door to keep it safe. Whereas your oil, you would need super tankers, and oil degrades over time. So they're actually active in the futures market rather than the physical market.
Okay, so let's come back to my first question then. So an ETF is active in the market right now, and ETN is active in the future.
Well, no, it's active right now. But what they might do in order to buy the underlying asset, rather than going to buy the oil, they would go and buy a futures contract on it. You would still get the spot price. In other words, oil today is, I don't know, 116, let's say. It goes to 120 tomorrow. You would have made that $4 profit. The ETN provider doesn't necessarily buy a barrel of oil. They've gone and bought a futures contract. In truth, they don't need to even buy a futures contract. They can hedge it any way they want. The ETF, they hedge by physically buying the shares. The ETN, it's up to the provider how they hedge. Now, the banks don't want to take what we would call a naked position, so they will hedge it using various different instruments, such as long-dated futures contracts.
Okay,
and the like.
I've just got such a horrible picture in my head when you just said bankers taking a naked position. It's just
okay.
It's not, okay, Roseanne
for
Bar
later
naked,
on
Roseanne
Wednesday
Bar naked,
evening.
Roseanne Bar naked, Roseanne Bar naked. Okay, I've got rid of that one now. Jeepers, that's a scary thought. Why would I though? I can understand an ETF, okay, because I don't want to physically have to go and buy X amount of this share and X amount of that one.
You don't want to have to go buy 40 stocks.
Yeah.
The costs are going to kill you.
I'm gonna buy Satrix 40.
Correct.
Or Satrix Divi. But why would I, and I understand the risks there, because that's going to go with the market. And from what I've learnt on this show, if you track the market over a fairly lengthy term, sort of 7 years or 10 years, you're going to, if you're not trying to time the market, you're going to make a profit on that, because that's what it's been doing.
And typically over long-term, best performing asset class is your market.
Right. So I understand that. Why the hell would I go out and put my hard-earned money into an ETN and incur even more risk?
Two things. One, because one would say that the extra risk you're incurring is modest, is relatively small, and compared to the risk of the asset, I don't want to say negligible, I don't want to create false impressions. It's there, but we can certainly say it is very, very small, and as close to insignificant perhaps as we can get it. And the point being is that some of these assets you might want to get your hands on, you simply can't do any other way. If you want to get exposure to coal, to oil, to Africa as an emerging market basket, you've got two choices. Either you go the ETN route or you go no route whatsoever. You can do let's look at oil, you could go and buy Sasol. But that's not a pure play on oil, because of course there's all of the operational leverage which can work in your favor when they do great, or work against you if they did terribly stupid things as management. So if you want that pure underlying asset, you often need to go that ETN route. And globally, what we've seen is a lot more ETNs coming up away from your traditional equities, the Satrix divvies, the 40s, and all of those, and there are 20 odd, in fact, I think almost 30 ETFs on the South African market, as opposed to not quite yet a dozen of in the ETN space. Simply, you want that asset. You've got your choices limited in that space, and the risk is small.
Okay. Having said that, then, there are, as I understand it, different types of ETNs. I mean, broadly, you can look at commodity, currency, emerging markets, and strategic ETNs. Is that right? Let's just go through those four.
I mean, in South Africa, we've got a lot of the commodity ones, platinum, palladium, silver, gold, coal and oil are the commodity ETNs in that space. And we've also got the gold ETF. And so gold, you can go either route. You have a choice there.
Okay.
So you've got your commodities there. Emerging markets in the South African space, we've broadly got really only the New Africa one, which tracks the Africa Equity Index, gives you exposure to 173 stocks across 29 African countries, excluding South Africa. Obviously, we would get those locally.
Okay.
Currency ones in the South African environment, as yet we don't have pure play currency ones coming out, but what we will have, and they will happen in our market, if not this year, certainly next, where you would be able to buy a euro ETN. So it would be rand euro probably, and in fact it would be a bet against that currency move. So if the rand were to weaken against the euro, you would make money on that space. So it would be a way of hedging a position or just taking a position on the rand. You think it's going to weaken, again, to delve into the pure FX market is complicated, risky, full of red tape. The ETN will be trading on the JSE with your broker. You go click, click, you can take some position there, some exposure into that. And then the strategic, in a sense, and it depends quite how we're defining it. I mean, it's that strategic versus the tactical. Strategic says you want certain asset allocation. So they're almost becoming multi-asset class. Now, we've got some of these that have come through already, although they've come through in the ETF space, because they've basically been equities and debt, in other words, bonds and shares. But you might get some now which say, you know, out of 100% of the pie, we would give you a little bit of cash, we would give you some debt, we would give you some equity, and we might give you some gold exposure or maybe some commodity exposure. So that would then be an ETN. And that decision as to what percentages that blend is the strategic part of it.
Okay, now, where do I access these, and how do I track them? Are they listed on the JSE? Under what?
I mean, that's the beauty of them. They're on the JSE. You can buy them via, if you've got a stockbroker right now and you could buy any other share on the JSE, you can buy these ETFs and ETNs. You can also go directly to the issuers. There's some central kind of like supermarkets where you can go to one site and get a couple, buy from a different couple of the ETFs and ETNs, but they trade on the market. So as you would get the price of SAB Miller or any other stock listed on the market, you would get it in the same place. They've got their own sector category, ETFs and ETFs, subsector of investment products. So you find them nice and easy. The prices are updating typically every 15 seconds on the market, so you can go and see, if you so wished, and I wouldn't advise it, you can monitor your portfolio 4 times a minute. But we're trying to pretend we have a social life here, so not advised. But certainly, the next day, the newspaper prints out the prices of shares. They will be printed there at the same time.
Okay, now this is where it starts getting difficult, you see, because now I think I have a basic understanding of what you're trying to explain to me. But this is where people like me get confused, because I then start thinking, okay, this sounds like it could be attractive. I have money to invest. Should I expose myself to this or one or two of these propositions? But if I'm going to expose myself to it, how much of my exposure should be invested in something like this?
Short answer, small. And we can delve in a moment to what small is. But for the average, when I get someone drops me a mail or stops me in the street and says, hey, saw you on TV, what should I buy? The answer is always very simple. Go and buy Satrix. It's nice, it's boring. As long as you've got a 5-7 year plus time horizon, someone just buy Satrix. Buy it lump sum, buy it monthly, just buy it. Now you want to get a little bit clever, and you've heard that oil's the next big thing, you know, OPEC, etc. Now you want some oil exposure. The point with Satrix is it gives you diversification to 40 of the largest shares on the JSE. Maybe you went for Satrix Divya, now you've got 30 shares, and you know, still you've got that huge diversification across different. You've got bankers, you've got brewers, you've got miners, you've got everything in it. Now you want to go and buy some oil exposure. You certainly don't want to go and take everything you have and stick it into one single product, because there's risk. Because yes, oil might go to 150, but it might go 250. It might go the other way down. You never want to put yourself completely exposed or overexposed to a single asset. So if you now say, heck, you know what, I think oil's a good story. I really, really want some oil exposure. In a holistic portfolio, 5 or 10% is pushing the boundaries in that space, because that comes back to that asset allocation. You don't want all your eggs in oil, because oil might go the other way.
So now I'm getting pedantic. Percentage-wise, I've got 100% of my money. Let's say 50% of it is invested in property. I've got some offshore exposure. I've got a local share portfolio. What, 5%? Should I
probably yes? I mean,
play with it?
There's going to be issues around risk and age, but as a broad number, I mean, I would say you're 50% in property is quite heavy into the property space. I would look at smaller property, probably bigger equity. But when you start going into single assets like oil, like any commodity, any of those type of things, you probably don't want more than 5% in that particular commodity. And then don't go and do 5% into 10 commodities, so you're 50% exposed to commodities, because you know one day commodities aren't going to be as sexy as they are right now. You know, you're maybe 5% per each commodity with a maximum of perhaps 15%. So maybe you take yourself a palladium, an oil, and a gold exposure at 555. And now you're at that boundary. You're pushing that risk boundary. You're right there. Don't now go and then go and do something completely crazy and put another 20% into another single asset class.